Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome to the Property Couch and welcome to you too, Ben. How are you?
G'day, mate. How you going?
Pretty good. Hey, I didn't get a text message from you on the week on Monday night. You didn't want to sort of congratulate me for two in a row?
Two in a row. Do you know that the ABC reported that Freo had broken their losing streak? And I'm like, I don't know what the ABC don't obviously watch footy because you'd won two in a row, so that's good. You got a WW.
Hey,
Yes.
just taking a few scalps. So I've clipped your wings the week before, and then our CEO Jamie, he's a Hawthorn supporter, so I just gave him a little reminder by text as well, so which was fun. Hey, mate, I just want to. Is everything all right with you?
Yes, mate. Why do you ask?
Well, it's a bit hard on podcast, right? But for people, I'm looking at a video of you. I'm obviously here at my house, and you're there in the studio. But mate, just you're the guy who's always official.
Mm-hmm.
I've never seen you in the office without a shirt and appropriate attire, and I don't know if it's the lighting in the studio there, but it looks like you haven't shaved today.
No, I'm growing a beard, Bryce. Yes, sort of COVID whiskers, mate. The boys were, I normally don't shave on the weekend. I normally, have a time, but yes, I'm religiously. I've shaven every day of my life for work all the time. But I just thought, the boys like the little scratch on the cheek and the little tickle when I kiss them for bed at night and stuff. So Harry said, "Don't shave, Dad, don't shave." So so I'm now being told I'm not allowed to shave for a little while. So yes, you might see a bit of the grizzly bear with the hair growing.
The Bisley Grey.
The Bisley Grey. So there you go. So,
hey, all right, folks. Well, for those of you that are not on Facebook, you'd better go and jump onto the Property Couch because Stiggy will put a photo up. The designer stubble. We thought we'd never see it from the Kingsley, but he's got a bit of designer stubble going on.
Oh, you've seen the handlebars and the mustache when we did Movember a couple of years back, but now it's the full,
yeah. I didn't see the early grunt work though, so there you go, folks.
Well, there's a lot more salt than pepper in there now, mate. So it's a little bit.
Well, I wasn't going to say that because people in glass houses shouldn't throw stones. Like my son, my eldest son, reminds me. I said, "I look pretty young," but nah. And I'm thinking. And he goes, "Dad, you got great hair." I was like, "Oh, come on, do the best with what I've got, buddy." So, all right, well, clearly, watch this space. You're going to get a bit.
Yeah,
wild.
But don't expect me to be posting pictures of me growing a beard, right? It's it's not like a favourite meal that I'm about to have or do anything of that. So if you're getting it, it's only through
showing your vintage, Kingsley. Showing your vintage.
It's through what Ivis is posting. Not through any means of I want people looking at this ugly mullet, and that's why I got to head for radio.
Yeah, no. Well, I think you're being a bit harsh, but anyway. So the Pippa Sentiment Survey reminder, Ben.
Yeah, big important one here. So if you haven't already filled it in, please do so. We'll be getting it into the show notes again. It's really important for us to get a snapshot, not only of the COVID piece. This is the one we do annually on behalf of the Property Investment Professionals of Australia, who are great supporters of the industry and educating people and making sure that people don't get ripped off. So please, if you've never done one before, give it a go. And if you have done one, it's great to get that data back in and get a snapshot in terms of what your intentions are and how you're coping financially through this period. So it'll take you 10 minutes to rip through. So if you can get that done, and obviously we'll send that out tomorrow. If you're already a subscriber in our community, as part of our movement, we'll put a reminder also in that email that goes out tomorrow as well. Thanks, Bryce.
The original survey too, isn't it, Ben? There's,
it is.
Guys
it's been going the longest, and it's the most thorough. And usually, we get upwards of 1,000+ respondents. So we're really keen to support Pippa in their journey to give those insights and get the voice out there for property investors.
Very good. Hey, Ben, my Mindset Minute theme today. You might recall that I'm doing a quick lap around the book, How to Win Friends and Influence People. I've got to say I'm loving it. So hopefully some of these insights are helping the good folk that listen to our podcast, Ben. But it's been really, really good. I read it when I was 18. I'm now circling back. But today's one, chapter 3, Ben, is he who can do this has the whole world with him. He who cannot walks a lonely way. And I just want to remind, I'm going to read a couple of quotes. And this book was written back in 1937, Ben. So there's probably, it could have talked more in the person rather than in the he, but just flagging that, that's the vintage of the book. But the principles are amazing. So a couple of things, right? I'm reading through it, just loving it. It's so story based. Again, there's a couple of books that I think. When I think of 7 Habits of Highly Effective People, when I think of some of the classic books, they surely would have grounded in some of these discussion points. But listen to this, Ben. Bait the hook to suit the fish, right? Makes sense. We've been fishing at your place. You put corn on. You don't put corn on too many times unless you're chasing carp. But if you want to chase carp, you put the corn on. So bait the hook to suit the fish. And so why talk about what we want, Ben? This is childish. It's absurd. Of course you're interested in what you want. You're eternally interested in it, but no one else is. The rest of us are just like you. We are interested in what we want. So some of these quotes are amazing. So the only way on earth to influence other people is to talk about what they want and show them how to get it. So first arouse in the other person an eager want. So he who can do this has the whole world with him. He who cannot walks a lonely way. So I'm going to give you an example, Ben. One day, this is straight out of the book, okay? So I'm quoting. One day, Ralph Waldo Emerson and his son tried to get a calf into the barn, right? But they made the common mistake of thinking only what they wanted. Emerson pushed and his son pulled, but the calf was just doing what they were doing. He was thinking only of what they wanted, so he stiffened his legs and stubbornly refused to leave the pasture. The Irish housemaid saw their predicament. She couldn't write essays and books, but on this occasion at least, she had more horse sense or calf sense than Emerson had. She thought of what the calf wanted. Got any ideas, Ben?
Yeah, okay. I think the calf wants food, right?
Yeah, well, not just a pretty face with designer stubble. So she put her maternal finger in the calf's mouth and let the calf suck her finger as she gently led him into the barn, Ben.
There we go.
So I'm thinking about this in my own life. So with the boys, there's a good book by Kevin Lehman called Have a New Kid by Friday, Ben. It's a very, very good book. We all want a new kid by Friday. You and I have got we've got young children. So the boys at night time, we've got into this habit of playing Uno together, Ben, right? And so the kids absolutely love it, right? So we use it as leverage, Ben. Finish your dinner. Who wants to play Uno? Yep. Because every parent or anyone who's got access to young kids really will relate to the fact that nighttime routines suck. You say the same things. It's like pulling teeth to get them to have a bath. It's like pulling teeth to get them to put their pajamas on. It's like pulling teeth to get them into bed. Like, it's just madness, right? So we've gone, well, is the prize. So we go, okay, who wants to play Uno? Yep. And they're all excited. We go, great. As soon as you've had a bath and you're in your pajamas, come straight back up here. We can play Uno. So that's been working, right? I've got a trampoline out the back, Ben. I've got the size, I think it's the size 5 Aus kick ball. I kick the ball to them into the trampoline so they can take speckies. They absolutely love it, Ben. So, of course, they want to do that. They're motivated to do it. So what do, boys? Have you done the dishwasher yet? No? All right. Well, once you've done the dishwasher, let me know. I can go and kick the footy. Right? So if A, then B. So, folks, principle number 3 from this wonderful, wonderful, wonderful book is arouse in the other person an eager want, which has been really, really good. So the recap, Ben. The fundamental techniques in dealing with people. Chapter 1 was don't criticize, condemn, or complain. Principle number 2 in chapter 2 was give honest and sincere appreciation. And principle number 3, arouse in the other person an eager want. Ben, get on it. If you haven't read this book, check it out. But if you haven't read the book and you don't want to check it out, stick around, Ben, because I'll keep summarizing it for the next few weeks because it is gold.
Sounds like a plan.
All right, Ben, our favourite Q&A day. So we put out a little word to the folks to say, what are your questions around buying in Victoria at the moment? We've got a mixed bag, to be honest. Some asked about Victoria, some didn't. The the point is that we've got a bunch of queries from the community, which is our favourite, right? What's the topic of the day, Ben? So let's get into, but before we hook into those questions, you wanted to sort of set the scene.
Yeah, I think it's a good scene setter for us, Bryce, in the sense that yesterday we got the biggest company in Australia, which just also happens to be the biggest bank in Australia. And to put it into context, they have about 28% of market share. Now, the big four banks in the country, Bryce, have about 85% of market share of banking in this country. So incredibly powerful. And what also that does is obviously gives us a lot of stability. So having strong banking system is critical for an effective economy. Now, Matt Comyn, who is the CEO, released the results with Catherine Livingston, who's the chair of the CBA, and there was some fascinating information in there, Bryce, and I just thought it's probably a great segue that they were interviewed, or Matt was interviewed on the Money Show, which is basically Brooke Courty on 2GB, 3AW and so forth. So we want to shout out and recognise where this audio content has come from. But I just think there's a couple of highlights that we want to go after in regards to this particular interview. And then let's talk to those as we build out and reinforce the case that we've been sort of putting for a while in terms of what's happening in the property market. So let's cut to that, a couple of snippets from that particular interview right now.
Looking at how you've supported the economy more broadly through this crisis, I see today 134,000 CBA mortgages aren't being paid, 59,000 business loans remain deferred. What are you doing to get these people to pay? Because certainly a chunk of them, a good chunk of them, I imagine, would be quite high risk in this environment.
Yeah, I mean, look, we and the rest of the industry moved quickly, and we received very good support from the regulators to be able to offer substantial support in the way of repayment deferrals to many customers, as you just mentioned. We've gone through now the 3-month check-in process. We've seen a reduction of about 20,000 of our home loan customers have opted out early of the 6-month repayment deferral. We've had about 30% of our business customers opt out of the repayment deferral. And in fact, in the business customer side, even those that have elected to remain in the repayment deferral category, they're actually continuing to make their repayments in full. But we anticipate that the majority, and we're certainly going to be working closely with our customers over the next couple of months to see them start making their repayments again. We do see the potential for customers to require ongoing support in the form of repayment deferrals after the end of September.
And will those be offered? Or is it at some point, I mean, what point do you have to say, well, basically you've got to start paying up?
We would like to, of course, and it's in a customer's interest to restart their repayments because, of course, they'll pay less interest over the life of a loan. So we'd like to see it obviously reducing, but there also may be circumstances where it's very challenging for a customer. It might not be viable depending on their independent or individual circumstances. So there will be some case-by-case analysis and conversations to try and determine what's the most appropriate for our customers.
And all of us are heavily invested in what happens with housing. Your own bank's worst-case scenario forecasts prices to plunge by as much as 30%. That's had a lot of coverage a couple of months ago. What chance does your team now place on that kind of worst-case scenario actually happening?
Yeah, and as you know, Brooke, we're required as a financial institution to contemplate a variety of different scenarios, and particularly severe scenarios, though, that we don't think are going to occur. And it sort of goes into the way we provision for future credit losses. And as you mentioned, that severe scenario, which we thought was very unlikely, certainly did garner some attention. I think our base case or our central estimate, which is very closely aligned with the Reserve Bank's forecasts, and they don't actually, as in the Reserve Bank, don't forecast house prices, but that's got a house price reduction in the order of 10 to 12%. That was our position based on what we could see in May. You'd have to say that to date, and it's only been a couple of months since that, that the housing market's been more robust than we'd expected. I mean, the national house prices for July sort of drifted lower by sort of 0.5% or just over 0.5%. So we've been surprised, and obviously positively surprised, that the housing market hasn't been as impacted. But of course, within that, there's some sectors and some geographies that are more heavily hit. We've certainly seen a reduction in rents, particularly in some of the inner city locations. And because population growth is constrained and likely to be constrained for the immediate future, migrants tend to be, in about 80% of cases, when people are coming to Australia, they start to rent. So we're certainly seeing pockets of surplus capacity, but so far the housing market, as I said, has been quite resilient. And I think, somewhat surprisingly, house prices for the 12 months to July in Sydney are up 12%, and in Melbourne they're up just over 9%.
Matt Comyn, thank you for your time, CEO of the Commonwealth Bank. Thank you.
Thanks very much, Brooke.
So Bryce, it's sort of some consistent messages that we've been sharing with our listeners for a long time are being validated by the biggest company in Australia and the biggest bank in Australia. And I just want to share some of the data out of their annual report. So just to give you an idea, Bryce, in terms of home loan repayments and what's been going on there. So inside there, they talk about their arrears levels. So consumer arrears greater than 90 days. So I'll just run through these stats. In June 2018, 0.7% were in arrears, greater than 90 days back in 2018. Move forward to 2019, and that goes to 0.68%. And that number is now down to 0.63%. So we are talking about very, very minute levels of arrears currently in place. Now, that obviously talks to the deferrals of what's been happening there as well. But as Matt was just saying, tens of 20,000 plus clients have already gone back on to getting repayments in place. And he anticipates that the majority of them come September will be back to making some level of repayments. But for those on a case-by-case basis, they will look to see what a solution is for those customers. And we agree, we don't want anyone to be paying additional interest. So if you're in a position to do so, keep building up that offset and keep doing that. So that was a really positive message. And talk to the message around property values there, Bryce.
Well, yeah, obviously there's some positivity around values. He's talked about at a broad level Melbourne and Sydney, right? We've always talked about that. Generalised commentary doesn't help anyone. But the point being is he is optimistic about the bigger picture in general, whilst there will be some casualties and some that do really, really well. I think there's an important point too, Ben, that he mentioned there. One is for everyone to just mentally bank that all of the hard work that's being done by the government and the banks and everyone to make sure that we go through this crisis isn't going to get to a date in the calendar where everyone goes, drop the mic, it didn't work, let's just turn it off, let's default on all these mortgages, let's just crash the system, right? We gave it a good 6 months, but now it's not going to work. Let's just crash our business, let's not get a return to shareholders, let's just turn the whole system off, right? So I think that's one important point for people to realise, that people will be making pragmatic commercial decisions. Because I always think, someone told me around decisions around justice, like the system is more important than the individual within the system, right? So therefore, some people will be casualties, but generally speaking, the system of banking is more important than the individual within the system. So they will continue to do what it takes for the banking system to go on. And second point is, the media versus the bank information that came out, Ben, and I think this is another very, very important point, because for anyone who's ever done property development, Ben, or done a feasibility study of any type, but let's keep it around property development. When you do a feasibility study around property development, you do sensitivity analysis, and the sensitivity analysis on a couple of things. It might be interest rates. This is what the interest rate is, but what if it dropped 1%? What would the profit be? What if the interest rate went up 1.5%? What would it be? Equally, here's what we think the end sale price will be, but let's do some sensitivity analysis around what if we actually get optimistically 5% more than we planned, and what about if we got 10% less? So we're providing ranges so that when you're making a decision about whether you're going to go ahead and do the property development, you're actually doing it informed on a whole bunch of different sensitivity analysis. He just said that the bank is required to do sensitivity analysis as part of their regulatory commitments to say, if the system dropped by 30%, this is what would happen to our book. And if the system dropped by 5%, but we think it's somewhere in 10 to 12. And I think that's really important for our community, the couches community, because they're a very educated community, Ben, to bank that lesson. Because the media, and Brooke talked about it then, where the media picked up on the 30%. But as part of what he had to do, as in his environment, he had to give out that sensitivity analysis to say, in worst case scenario, this is what's going to happen. And if people can let that land, they can then go, okay, moving forward, when in 7 years' time or 10 years' time or whatever next X Factor event happens, or 3 years or 3 months, they can start to apply some of these templates and these filters and these frameworks so that they can make decisions and take advantage where people, other people who aren't part of an educated community around this sort of stuff may make emotional, rash decisions.
Well said, Bryce. I mean, ultimately, we've been consistent in this message that the government, the regulators, the banking sector will continue to kick the can down the road, come each wave of infections and what happens to the economy. They are poised to put more stimulus in if they feel that the vast majority of people are going to be impacted. But they obviously are still seeing billions of dollars flow in through JobKeeper and JobSeeker every fortnight, and that's going into the coffers. If you, I'll find also the savings rates. It's just, there's a graph that's just extraordinary in terms of the amount of inflows that are coming into bank accounts at the moment, because we're not spending, Bryce, because we have no mobility. We can't spend on things that we would normally be spending on, takeaway and going for lunches and dinners and out for drinks and holidays and all of that stuff. So this has been consistent with our messaging around, yes, things are tough. Yes, unemployment is tough, but the vast majority of households have solid buffers and will be able to get through this by working in with the banks. The banks have no appetite in forcing a crisis and also a crisis of confidence, right? So, but what else did they also recommend? They were surprised. They were more robust. Now, this is a marketplace that operates on supply and demand. Supply dropped, demand stayed steady. And so that's why we haven't seen significant falls in the property space. And then referring to rents, really clear. There are pockets of trouble, and we've identified those and we've shared those with our community, and we'll continue to talk about those pockets. But we'll hear an interview from Leah later in the show from the REIV, who talks about some of the interest she's had on units in the outer suburb areas. So that's also of interest to hang around for the remainder of the show. But it's just about putting context around it. We know fear sells, right? We know even in our own, if there is a negative headline, we're more likely to read that story or listen to that story than a positive headline. So it's important. If our headline for today's show, Bryce, was sell everything, it would go to number one. It'd go to number one on the list, right? Because sell everything, everyone. And then everyone's going, oh, wait a minute, these guys are positive property. They're saying sell everything. And then they'll listen to the show, and then they'll basically be in a position to go, actually, that wasn't their message. But they got me listening because I was fearful. And that's the loss aversion playing out, where we feel like if we're going to lose something, we're really interested in it as opposed to gaining something. So we say to everyone, and we're being consistent in this message, in our calm message, Bryce, if you're in a position to do something, what we do know about when inflation and interest rates are low, asset appreciation does move higher over the medium to longer term. And that is by manufactured outcome from the regulators and the banks to stimulate the economy. So we are still very bullish in terms of what's going to happen to property prices over the next 3 to 5 years. So if you're in a position to do something, now is a very, very good time to beat the competition. If you're not in a position, it's all about cash flow management, and we've got some exciting news coming as part of our 300th show, where we will talk about one of our new features on our platform, Bryce, on the My Wealth portal. So looking forward to sharing that as well.
All right, Ben. So that's set the scene for today, which is very, very good. So thanks again for getting that audio from Money News with Brooke Cordy. So the first question we got, Ben, was a finance question. It's from Matt Feely. If I buy an investment property with equity release and create 2 loan splits, i.e., let's say 100K equity secured against a principal place of residence and a 400K home loan, if I sell the principal place of residence in the future to upgrade the family home, what happens to the 100K loan that is secured to the PPR? What are the options? Thanks a lot, guys. Ben.
So yeah, no, it's a good question, Matt. So a couple of options you've got is, firstly, obviously, you can do a substitution of security of that particular loan if you're going to keep, or you've got another secured property that you can loan it against. Obviously, what we're trying to do here is not break the nexus, is the terminology used, where the loan is deductible, and so we want to keep it separated where we can. So in some cases, if it's 5 years down the track or 10 years down the track, if the value of the investment property has grown significantly, you can actually substitute the security and keep the loan live in with the actual investment property itself. And that is quite common after 10 to 15 years, where you will have enough value in that property that has grown to move all of those loans directly into that particular property. Now, if you don't get the capital growth and the property remains stagnant, well, hopefully you haven't waited 10 or 15 years to realise that you may have bought the wrong asset. And if you are then ultimately going to sell your property, you just need to then work out where you're going to place that loan, because one of the things we do not want to do is pay out that loan if we're still in accumulation phase. If we're in, sort of pension phase or retirement of debt phase, then ultimately we do want to retire debt at some point, and that's obviously where we get that passive income. So it is a matter of, you can still refinance that loan, or you can do a substitution of security, and it's about working out basically where you would put that loan to allow you to continue to get that deductibility, because the purpose of that loan was against or to buy that investment property, Bryce.
Very good, Ben. An investment savvy mortgage broker would be able to help with that, Ben, and they can do all the things that you just talked about then, Ben, to make sure it's not polluted, it moves, it's all nice and straightforward for you. So thanks for your question, Matt. We appreciate that. Hey, this one's from Cameron Hall, Ben. Not really a question, but thought I'd share our experience selling our home recently. Went on the market 2 days after Melbourne went into stage 3, but despite individual inspections and the associated hassle, there was huge interest, in brackets 25 plus groups, Ben, and it sold in 5 days for what we wanted, and a street record in a pandemic. No shortage of demand, at least in our area, from what we've seen. Hope this helps anyone worried about selling. Good commentary. Maximus Decimus Meradius. Ben, that's there's a lot of syllables there.
There are.
This is a buy, rent and sell question, and although specifically about the Perth market, I think it is valid for all of Australia. The media reported last night that the Perth median sell price has slipped below Adelaide and is second from the bottom, with Darwin sitting below Perth. However, the rental vacancy rate is 200 less than last month, and about half of what it was this time last year. I believe I heard you say in a podcast a few weeks ago that potential sellers are holding onto their properties because they know prices are real low. But has distress selling pushed the median price down? Or are the media looking at stats at a certain point in time which reflects a bad run of lower cost properties being sold in distress or otherwise? All these stats don't match up with what I'm hearing about rental vacancy rates in other parts of Australia either. And finally, we are looking at rent vesting. Yet is it better to look at buying in Perth right now rather than rent vesting, or does that depend on the suburb? Bit in that one, Ben.
Oh, there's a lot in. How long have we got? I'll see if I can break this one down. We've said this before in other periods of slowdown. When you look at sort of 500 to 1,000 properties a week, which is quite common in a normal market environment that we're in our business, as we're ascertaining and potentially buying in New South Wales, Victoria, South Australia and Queensland at the moment, we tend to measure and read what we call quality of stock. And we do know that in these sorts of times, that the quality of stock is usually a little bit lower. And so the properties that are going for sale are what we call potentially lack that owner-occupier appeal. They still might be in okay suburbs, but they might be on busier roads, or they might be in the high density accommodation and those types of things. And so we don't have any statistical validation of this, because we aren't measuring the images of the property or the internals of the property. One day, as machine learning and AI gets better, we should be able to sort of make that definition in terms of what makes owner-occupier appeal or not. But what I'm trying to articulate here is this story that usually we get a bit of junk stock that's coming into the market and being sold at this time. It's a bit like what happens when some properties are sold on weekends where there's a public holiday and go to auction. Usually, if there's a long weekend, the properties that are selling that weekend aren't the signature, the high-end properties. And so we normally see, that sort of stock just moving on. It's just sort of what we call mass stock as opposed to really particular owner-occupier appeal stock. And that impacts median house prices, as does, an example where in the outer suburbs in a new estate where subdivisions are happening, that can also artificially inflate median values in that area. Now, the existing properties that were there that were built 20 years ago in the original subdivision haven't really changed much, but because the new subdivisions and the land sales and the properties that are being built on there might be McMansions, it can look like that the property prices in that area have gone up by 40%, when in fact they haven't. All that's happening is the final settlements of those properties are taking shape. So what I'm saying is medians can be manipulated in certain circumstances. So you've got to be conscious of that. And that's potentially what we're seeing now, where we're seeing potential, the good quality stock being held back, looking for a better buyer, and the owners also saying to themselves that this is a good quality asset, so I want to wait and see what happens in the marketplace to be putting that good quality asset in. Whereas if they're getting feedback from the selling agents, they'll say, you know what, it's not the greatest property, let's be honest about this. I think if we can get it sold and get you moving on to your next journey, we will do that. And that's what we tend to see from our observational analysis inside the market, as opposed to what's in the raw data, which is a midpoint, when we're talking about median price. I'll get you to talk about the other stuff because I've rabbited on for too long.
No, it's all great stuff, right? But the thing is, we always like to give people a framework so that instead of just relying on us being able to answer it, hopefully you can take the framework away so that you can overlay the same question. This person is talking about the Perth market, but if you have the same question in Tasmania, you have the same question in far north Queensland, in fact, all around the world, the same thing applies. But what we're trying to do as a podcast and as a community and as a Coucher community, Ben, is equip people to make decisions around real estate where they can filter it through, as I said, those frameworks. So number one, hopefully through when we were chatting about the quote from Matt Common, is that the headline is not going to serve you at all, right? We have the thing that searching is not researching. It's because if you just follow the headlines, you're going to be in trouble. So it's better understanding what it is that, okay, I've identified a couple of suburbs, and then getting information around those particular suburbs, working out where within those suburbs, where are the people who earn more income as an average across the suburb versus, so you can work out where the A streets are versus where the B and the C are based on income, because we know the higher the income, the higher borrowing capacity, the more you can spend some money. So again, trying to ignore the general commentary is the theme of what we've been doing for 299 episodes, and get specific, because a couple of things in Perth, despite the fact that Perth has been flatter for some time compared to the East Coast, there is a flight to quality in Perth. If you go to the better suburbs, you go and find out what the owner-occupier appeal is. I can guarantee if you go and analyse a property in that is quality, that has owner-occupier appeal, that has all the basics that we talk about, I bet you if you back-tested that property, you'd see that there's been some positive performance. And then versus the national commentary around Perth as a city and Western Australia as a state, right? So I think if we go back to your question, Maximus, you're talking about, okay, well, does the stats don't match up with what I'm hearing, right? The stats never match up. Like, they just never match up. Journalists ring us up, and we don't do it anymore, Ben. But in our early part of our professional life, they'd say, okay, give us a couple of hotspots, and we just name a couple of suburbs, and then they get someone else to name a couple. There's no consistency. It's just pulling information together, right? So again, I cannot stress enough that the headlines will not serve you as much as being able to understand the frameworks of what makes for a great suburb, what makes for a great street, what makes for a great property, what makes for a great floor plan, and what is appealing to an owner-occupier versus a tenant, and then understanding the 4 things of growth, yield, vacancy rate, and the quality of the tenant, Ben. So that would be my answer to Maximus. I want to teach you to fish so that you can ignore all of these stats as best you can, so that you can actually make some good sound analysis on whether you should proceed or not.
Yeah, it sort of reminded me of the messages that we've been having over the last couple of weeks, Bryce, about this pent-up demand and you know what's sort of happening. There, you will know pretty quickly, Maximus, in terms of when you're looking in a particular market, you will see how much activity is happening, how long properties are staying on market. So, you know, if you're looking to buy soon, you probably want to do a couple of months of research and watching the market, and you will get a feel in terms of the markets within markets that we're talking about. The other way in which you can shortcut that is to look at demand and supply ratios. And we obviously have lots of great research tools through selectresidentialproperty.com.au that you can have a look at those research tools, and they will give you the read on all of the important, critical, sensitive data sets that measure that, and that's what's going to move value over time. So I think it's also important to note that that's available too as well if you want to fast track your searching around that. So, you know, and the final part of your question, Maximus, about rent vesting versus buy in Perth right now. I mean, we heard Nerida from realestate.com.au and the RA group sort of just only the last couple of weeks, couple of episodes, that there is, Perth is doing okay. You know, there's mobility. The economy's going all right. Iron ore prices, mining's going well. And so that market is holding up. And you just saw the vacancy rates, 200 less properties available for rent. That means that population is moving and there's things that are happening over there. So, you know, that's going to show up in the data as well. And so I would have thought that, you know, if they can remain, you know, in a positive economic state for a while, that we might see Perth have a flat result and maybe even some growth coming into the end of the year. Now, coming back to the question about rent vesting versus buying in Perth, that's a really important sort of what I would say one-on-one type conversation. What are your short, medium and longer term goals? Rent vesting isn't just about, you know, the next 5 years. Rent vesting is a long-term strategy that has a payoff, but the consequences of that payoff is potentially, you know, do you get your own home eventually, right? You know, rent vesting isn't just about saying, well, I'll just quickly grab this property and I hope it goes up in value in the light of me selling that property and then, you know, taking the equity out of that to find our perfect home. Some people refer to that as rent vesting, but that's just getting on the property ladder and being smart. Rent vesting is about staying the course and renting for the period of time over many, many years, 20, 30 years, and building out a portfolio of properties. And there are risks and rewards associated with that. So I would say if you want to live in Perth and is Perth the place for you, it has been a depressed market for a long period of time. So, you know, do your research, do your due diligence, and you'll start to get an idea in terms of what's possible for you.
Yeah, good point, Ben. Because rent vesting is you can't sort of dip your toe in and then change your mind and pivot, because it's like trying to pivot the Titanic, particularly when you've got to throw a principal place of residence in there, right? So it's more about having conversations. If I live in a market where there's better opportunity in other markets, so let's pick a secondary market. I won't name any, just not to offend, but a secondary market I live in, and I think I could get better use of my money from investing in a primary market. That might make sense. Or if I feel like I'm going to be a long-term renter my whole life, that makes sense. But if you have this burning ambition to touch your own four walls at some stage, Ben, you don't want to go into it lightly. Hey, I just thought of something before when we were talking about the purchasing, Ben. Just to give some insight to our listeners, because we take it for granted, Ben. We deal with property all the time. But I head up a professional buying team, Ben. We've had some of the best buyers agents in the country on our podcast, Ben. And I can assure anyone who's listening to them that my team, the other buyers agents that we've had on our podcast, they do not do their research through headlines, ever.
Correct.
They do not do their research through headlines, ever. They are doing their 10,000 hours. Now, I could put a property on a desk of one of our buyers agents, and they could, within an instant, Ben, know where to tap the engine block. You know, you remember that analogy.
Yeah.
They know if it's a good property or not because they've done the 10,000 hours. We can see a property come onto the market and know if it's a good one within 5 minutes based on just this long experience of being in the market. As you said before, we know in that suburb days on market, the stock doesn't last long. The rent off their chops, there's 6 applications. We just know that from anecdotal evidence of being on the ground, right? So if a professional buyer, both within our own team and I can speak on behalf of every other buyer's agent in Australia who is experienced and qualified and knows their stuff, they do it from on the ground. So if no one else who's professionally buying property is using headlines and generalized commentary, you shouldn't either. So I just wanted to do that as a bit of a full stop on the previous point. So good question, Maximus. Thank you for that. We appreciate it. This one, Ben, is from Hugh Gates. Hi, guys. Currently building a granny flat on the back of my PPOR at the moment, which will be leased. My question is, will my serviceability for future investment loan be increased if I lease the main residence also? The flip side is that the repayments on the house are lower than the equivalent I would pay in rent, i.e. repayments at $330 a week and rental is $450-ish. However, the rental income I would generate on the house would be equivalent to that of the rent I would be paying, balanced out, I guess. Love the show, boys, and Stiggy. Have listened to a lot and have read one of your books. Keen to read the next. Thank you for your time and commitment to bettering others' futures, be it financial or otherwise. And then a little edit. Sorry, New South Wales, not based in Victoria. That's why I was saying at the beginning.
Yeah.
Ben, there's a little bit around finance there.
Yeah, there is. So what Hugh's trying to ascertain is, building a granny flat on the back, will lenders assess some of that rental income while it's it's got plans and permits, it's all done professionally and correctly. If it's professionally managed and you get a property manager to give an estimate, or you get a tenancy agreement in place, then yes, 60 to 70% of that rental income will be accessible as part of your servicing. Now then Hugh goes on to say, well, that's good, that's going to increase my borrowing power. Wait a minute, I've got another idea. What happens if I move out of that property and go and rent somewhere else? How much of that rental income would be available to increase my borrowing power? And he's making the point that the rent that I would be paying at $450 versus my repayments means, obviously from that point of view, the house is most likely going to be neutrally or positively geared. So that's why he's looking at that. But he's then also trying to work out, will the rent that I pay and the rent that I get effectively balance themselves out, and how would that impact in terms of my borrowing power? Well, the rent that you pay is charged at 100% from an expense point of view from a servicing calculator, whereas I just said to you that the rent you get from an investment property is only at 60 to 70%. So it may not be the sort of result that you're looking for. If you were going to rent at a lower level and rent your property out at a higher level, then that could potentially move the dial on your borrowing power. But if it's net, usually it's not necessarily going to increase your borrowing power. It may reduce it, because servicing calculators will only take 60 to 70% of the gross rent when they're assessing that from a borrowing power and servicing point of view. So hopefully that gives some clarity.
Good answer, Ben. Thank you for that. Hey, this one here is from Heath Ian Sullivan. Ben, thoughts on Queensland being bombarded with Melbourneites, in fact Melburnians, trying to escape from the city? Oh, there's a few little mixed references there, Ben. Everyone's jumping up the border. They're buying sight unseen. They're buying 7-figure real estate without even doing an inspection, just to get into the loophole of just escaping stage 4. What do you think?
Wow, look, there's no doubt that we've seen some media coverage on that, and I suspect it's not a material number, but it's real. They've interviewed people that have done it. So when you get stories like that, you think that the vast majority of people might be moving to Queensland. Not necessarily enough to potentially move the dial in terms of the demand supply story that we're seeing. But yes, it is a way in which you get a special exemption to get out of Melbourne. Under stage 4 lockdown, you buy a house and you move to it. And then, who knows, it could be a holiday home that you're going to have in the future. And then the plan is, once Melbourne's back in good shape, you decide to change your mind and go back to Melbourne. Look, Melbourne, it's one of our, it's our cultural centre of Australia. It's the sporting capital of Australia. It's one of the knowledge centres of Australia. It's the 25% of the overall economy. It's an engine room of our economy. And so it's a multicultural, very accepting city to live in. great university. So I'm not buying into that story that Melbourne and the greater area of Melbourne is not, some of the best and most livable cities in the world. We've had a government that's probably dropped the ball. Well, not probably, has dropped the ball. And so, that's obviously causing us some undue stress and unnecessary angst. But, think past COVID, think about the long-term story about immigration. I think it's 1 in 3 want to live in Melbourne when they migrate, and that's pretty powerful in terms of the population story and the demand for property in the greater Melbourne basin over time. So I'm not so worried about that story, Heath. I think it's a bit of a beat up.
From Heath's perspective, we don't know what point of view he's talking about. Is he a Queenslander worried about Melbourne people coming up, or is he Melbourne person worrying about the vacuum of people leaving? The fact that he wrote the fact that he wrote Melbourneites, Ben, tends to suggest that he is more likely to be from Queensland than Melbourne, because I'll tell you a little interesting side story. Veronica got slammed on location Australia, because she used to refer to them as Melbourneites, and someone wrote into us and goes, well, if you lived in Melbourne, you'd know they were Melburnians, not Melbourneites. So, so there's a little insight. Hey, Heath, I don't know. If you're worried about it from the perspective of people moving out of Melbourne, don't worry. There'll be plenty of people to take their spot. I mean, it's not a case of the last person to leave Melbourne turn the lights out. There'll be plenty of people here. But what I think is it's a positive story for Queensland, because Queensland's actually had a few false starts, Ben. Oh, is it Queensland's time this year? Oh, didn't quite turn out. Oh, is it Queensland's time this year? And so the fact that people are creating increased demand should just get people in Queensland who, Ben, get ready for this, who have quality assets, that have owner-occupier appeal. You know where I'm going with this. If they've got good A-grade properties, they should be excited by the fact, if from the perspective of property value growth.
Yeah.
If they're talking from the perspective of NIMBYism, Ben, not in my backyard, we don't want any of those Mexicans coming up here. Well, then that's just progress, and that's another discussion that we're probably not qualified for. So, so there you go, Hugh. Very, very good question. Thank you for that. Ben, this one's from Sonia. It's also a finance question, and we've had it before, and it's popped up again. So it might be worth us just revisiting it, just in case anyone has any anxiety around this from your perspective. But Sonia Malia said, what to do if we have over $200,000 in offset and the banks can now use our money if in financial ruins and not pay it back? So maybe you could set the groundwork for the backstory and then give your commentary.
Yeah, sure. So governments insure ADIs, or authorised deposit taking institutions. That's a banking licence right there. So any individual is protected by up to, and I think it's $250,000. I think it's 250, not 200. Yeah. So 250. So that means each individual or a household on a bank loan or a bank or money in the bank, if you've got a joint bank account, that's 500. Now it's more of a trust and a safety mechanism, right? So if there was runs on every bank in the country and everything went broke, which just it's obviously not going to happen, and that's APRA's job, right? The prudential regulator has liquidity requirements on our banks that are world's best practice. Basel II, Basel III, all of these arrangements that they have is about a fantastically stable and strong banking system. And we're seeing that obviously being spruiked by the Reserve Governor and the Reserve Bank. We are in a fabulous financial position in terms of liquidity and banking setup. So the likelihood of a bank going broke during these times when, we've led the show with this whole idea of how strong the banks are and how minute the rates of deferrals and also distress selling. And we heard Nerida talk about of the 100,000+ properties they've got for sale on their website, 5 were mortgagee sales. 5. So I don't think you've got too much to worry about this, Sonia. I am seeing some doomsdayers and naysayers in this space who are spruiking the fear that their money could be lost. But just be mindful that yes, it's $250,000 per banker, so per customer, that you are protected for. So the likelihood, and you only just need to listen to any serious economist, not any doomsdayer or headline attention-grabbing a commentator that money is very, very safe in the Australian banking system at the moment. And we've talked prior about this before, that if you're in a fortunate position where you've got a huge amount of cash, then potentially having two different lenders and two different banks with offset accounts, if you want to increase that or reduce that risk. But we're talking about a very small percentage of the population who would be in the luxurious position of having $300,000 to $500,000, $600,000 of liquid cash, sitting in offset accounts against potentially a couple of different banking institutions. So, but for those who are in that fortunate position, you might want to basically hedge your bets by having a couple of banks if you feel that there is a risk here. But for me, there is just absolutely no foundation to any claim that our banking system is at risk in the current situation.
Here. All right, Ben, the last one that I want to cover today, thanks to these wonderful questions. TD, T-double-E, D-double-E, Ben, TD. With stimulus being used to prop everything up, is it fair to say that we can expect to see an initial deflation in the market, 10 to 20%, followed by a severe inflationary period as the mass amount of new money finds its way to the bottom of the pyramid when everything else opens back up via rents and prices? If we keep our current monetary system, the only way to repay this debt is through mass inflation. That tells me to hold my assets, switch to interest only, in brackets, despite low interest rates, Ben, and pay off my debt using tomorrow's devalued dollar. Is this a naive way of thinking? Thanks, guys. It kind of sort of harks back to last week when Nerida was talking about modern monetary theory, Ben. That's a sort of a tactical question around that.
This is an intelligent question from D on a couple of levels. TD. On a couple of levels, T. Sorry about that. What's intelligent about this is T understands that when money is cheap, you do get asset appreciation, and that's consistent globally. It's one of the key levers that we use to get through the GFC in terms of manufacturing asset appreciation, so we didn't collapse the system. And it's obviously, where we've gone to in terms of quantitative easing and the printing money story that we're seeing around the world at the moment. So it's the modern monetary theory is an extension of that. But basically what T is talking about, if money is really cheap, inflation usually does turn up at some point. So when the economy starts to move forward, we start to get those inflationary aspects. And because obviously, oil prices are down because no one's driving, the whole thing starts to take shape. Now, the lever that the RBA governor has available to him is to then start moving the cash rate higher and making money a little bit more expensive. And that's how they measure inflation. But the point that T was also making was really fundamental. And it's one of the things that we haven't talked a lot about, but property is a very, very intelligent inflation hedge. And by that, I mean that if you own the property and what T is talking about there in terms of the cost of money and so forth, when you own that asset and the cost to replace that asset is increasing on an inflationary element, so to build the dwelling on top of the land, then ultimately it's an excellent hedge because you're getting that appreciated value as part of that inflationary story. Now, the whole concept of modern monetary theory is the risk of seeing inflation go out of control, and also, it has severe impacts in terms of potentially devaluing the dollar. So there'll be still continued debate along with a lot of economists about whether it's a viable theory and it's a viable approach. But right now, we don't really need to worry about that. We've got a government in terms of the level of debt they're holding is still moderate compared to global numbers. And you don't have to, so the other point that T was talking about here is he's saying that, you would need to, mass inflation is the only way in which you'll ever pay off debt. That's not true. The other way in which you ultimately pay off debt, and this comes back to what Menzies did post the Second World War, is you do borrow a lot of money to get the economy moving. You bring population in and you build more production, more output. And when you get more output, you get more taxes. And when you get more taxes, you can pay that debt down. So productivity is a big key. Mm-hmm. And that's why this government is also talking about industrial relation reform and some are, a think tank around that's coming up over the course of the next, I think, couple of weeks or months. We will see debates going on about this, because if we can get productivity up and we get more people employed, and more people employed means more tax revenues, more profitability for companies, we take those cash receipts and we recycle them back in the economy in terms of paying debt down. So, and that's when we all obviously get to surplus governments as opposed to deficit governments. So that's an important message here. And what I've also been talking about is the cost of money to government is cheap. So we will see more investment into infrastructure, and that infrastructure bodes well for livability and demand for those locations. And so governments, all levels of governments, get that return on investment, whether it be the capital gains that the federal government get, whether it be the stamp duty that the state government get, and then the land taxes or land rates, which also come into the state and local government coffers as well. So it's not the only way in which you get an inflationary return, but the cost of money being low is a good hedge for property, and especially residential property.
Yeah, Ben, you raised some good points, and there's some good valid alternatives on how it gets paid back. I always think that, for me, which is why I like real estate, because it's tangible versus, say, a paper asset. Now, I'm not getting into a debate about which is better, right? But if that scenario goes hyperinflationary, you can use future dollars to pay off the debt, but then it all goes back to an equilibrium, water finds its own level. At the end of the day, you're still left with a tangible asset that doesn't necessarily go to zero, versus having a paper asset, which you don't have any control over. So another reason why I like bricks and mortar, and why it's that tangible asset. So in the scenario we just described, it's another hedge against alternatives. So good question, TD. We appreciate all of the questions from our folks today, Ben. There was a fair few. There was a bit of a cross section. So thank you to Sonia, thank you to Heath, TD, Hugh, Maximus, Cameron, and Matt for joining us on the podcast today, Ben. My life hack today, Ben,
yes,
is really it's shouting out to those in ISO, right? So I was chatting to Brad Kelleher, who's part of the buyers agents team here, and he is climbing the walls in stage 4, as I'm sure a lot of stage 4 listeners can relate to. So I said to him, "What is it that you're doing to help with your mental wealth during this time?" And he said, "Well, one of the things I've been doing is because I can only go for exercise for an hour within 5 kilometres of where I live." So what he's doing is he's going for a run, but not just a jog. He's going for an intense run, Ben, so that at the end of it, he's gassed. And the thing is, he said, "I'm addicted to the endorphin pop," but it's also, when we're chatting, it's about when your body is going into recovery, trying to get the oxygen into the body and all those sorts of things that come from being totally gassed. You don't have time for distractions and negative thoughts and all that sort of stuff, because your body is in full mode for recovery. So last couple of weeks, a good mate of mine where I live, we do the tour to Bells, Ben. We ride our bike about 7:30 at night when the kids are down, go up to Bells Beach and back. Now, the advantage for me is he is infinitely fitter than I am, right? So he sets the pace. And my pride is I don't want to get left too far behind. So by the time I get home, I'm gassed. But I've got to say, from my own experience, it works a treat. So here we go. My life hack today is for those don't have to be an ISO, Ben, but clearly it's an ISO strategy, is to get yourself into some intense form of exercise, whatever your favourite is, and get to the point where the heart rate's ticking so much that it just gets rid of all the mind chatter and all the clutter, because you're just on your own natural juju beans that comes from those endorphins. So, mate, what's making property news?
Yes, Bryce. Well, last week we had Leah Calnan on, and she was talking about, the changes happening down here in Melbourne. We promised to circle back to her for an update in the last 7 days in terms of clearing up a couple of unanswered questions. So we recorded this earlier. Let's cut to that chat with her right now.
All right, Ben, we've got a very special guest, returning guest. We've got Leah Calnan, the president of the REIV. It's been a week since we chatted, but it's probably been a really long week in real estate. Leah, welcome back to the Property Couch.
Thanks, Bryce. It does feel like it's been a long week. Yes.
Hey, last time we chatted to you, you'd received the directions from the Premier's office merely 10 to 12 hours before we chatted. So you've had a bit of time to digest what that looks like. And no doubt you've had a lot of people come to you and say, "What about this? What about this? What about this?" What can you tell us about the last 7 days and the clarity that you've got from what the real estate profession can do and property buyers in general?
So it really still is a work in progress. That's the first thing that everyone needs to understand. And I do have sympathy for a government trying to manage all industries, because it can't be easy. But we have got clarity on that you are able to facilitate services relating to up and coming property settlements. And what that will look like is that if you have a finance requirement and the banks need to get and do an inspection, if there's a pest and building inspection, if leading up to settlement, the locks need to change, anything around, and the wording is services relating to the up and coming settlement, property settlement. And that also does mean that the agent can go to the property to hand over the keys. I said to somebody yesterday, they asked about how many people could come, and I said, well, really, it should only be the people who are on the title. It's not the time to bring Nana and, your second cousin and your BFF and any of those. So keep it minimal. We've got clarity on end of lease and also commencement of tenancies, because we knew in one part of the directions you could move home. But what they seem to have missed is that how were real estate agents going to facilitate that moving of home process. So around end of lease, and it was interesting, as soon as we highlighted to government that if a property manager can't facilitate an end of lease process, the tenant can't get their bond back, and they were like, oh, okay, we obviously need to make some changes. So yeah, interesting that they're the sort of triggers that get them going. But tenants can organise steam cleaning of carpets, general cleaning, any services relating to ending the lease. Where it's gotten a little bit tricky is for property managers, when they go to do that appointment, they have to do everything. And when I say everything, they have to do everything relating to that final inspection, and then think about the new tenancy. So the virtual video, potentially the online tour, the ingoing condition report, the placement of the keys, everything in preparation for that new tenancy.
So with that as a backdrop, with all that virtual, can we then get someone who, it sounds clear that pretty much any contract you have, you can do whatever it takes to finalise that transaction within reason, without, like, as you say, the BFF coming along. But it then becomes a place, well, okay, now we've got a vacant property. Can they get a tenant? Now, you talked about the virtual tours. Can you get your job done as a property manager outside of your role as the president of REIV for new tenants outside of what we just talked about?
Yeah, look, it is tricky. So as you guys know, I run multiple hats. So my team, we thought we would trial something for the industry. We started that on Tuesday morning, and we had 2 final inspections. So with consent of REA, we uploaded, or we notified in our marketing that we were going to do a Facebook Live open for inspection tour. So that was on the REA marketing, and then went through to our Facebook page. From those 2 final inspections / virtual open for inspections, we generated 5 applications for each property. So it's only really small data, and I said this yesterday to a group of agents. It's a really good start though, because it's making us all think differently. Basically turn everything upside down and think about how we can do it a little bit differently.
And Leah, in terms
you guys can have that idea for free.
Yeah, that's brilliant. I'm writing a note. I've got more questions, but go on, Ben.
No, that's all right. I mean, we don't run a property management business. So the challenge still is around buying property, obviously.
Yeah.
And if I'm a buyer and I want to spend $500,000 on a property, am I allowed to physically see that property before I sign the contract?
No. So at the moment, whilst we're in stage 4 lockdown, you can't physically see the property. But that being said, I've had 2 reports from agents, one in, I think it's in and around the Aspendale area, and one on the Mornington Peninsula. And both agents were able to facilitate a Zoom open for inspection. So the vendor ran the camera and the agent actually talked through the property. On each occasion, I think they had about half a dozen prospective buyers watching the Zoom. And on both occasions, they actually generated a contract. Now, there are still conditions, and I'd suspect one of the conditions is not only subject to finance, but subject to inspection. But, if it was me and I really love that property, I think that's a great step forward for a prospective buyer.
So what you're saying there is one of the conditions could be I've accepted a price, I've accepted but here's a condition I have, and that is upon the easing of lockdowns of restrictions at stage 4, when they get back to stage 3, I can go and inspect that property, and subject to my satisfactory viewing of that property, the contract is valid and proceeds to the desired settlement as per the settlement date that was agreed to inside that contract that was executed. Okay.
Yeah, absolutely.
So what about the chance of getting a building and pest inspection as well? Because obviously you can do that as part of the settlement process. So if I've signed a contract, technically that's a settlement that's going to proceed. So technically, can I get a building and pest inspection on that property?
Well, it would relate to the services relating to facilitate that up and coming settlement. So yes, what you just need to think about is the agent doesn't need to be there. It can be, Mr. Pest and Building person, here's the vendor's details, I've booked the time, it's happening at 11 o'clock tomorrow, go and do your job. And I think that's what the agents just have to realise. They don't have to physically be there to facilitate that.
But that would be subject to the contract being executed. Yep. That's what we've got to be clear on.
Yep.
So if you haven't executed on a contract, then technically it sounds like you can't get a building inspection done on the property.
That's right. It's not one that often prospective purchasers do before they want to consider purchasing. Yeah.
That's a really good example that you two have been riffing on. So for clarity, if you were able to enter into a contract in stage 4 without inspecting it, like what you talked about before, then it still qualifies that you can do whatever it takes to settle, versus if you needed to have got the contract done before we went into stage 4.
Yeah.
And so one of your conditions could be a building contract inspection, right? So you could say, as part of the conditions of sale, I want to have a satisfactory building and pest inspection on that property. Is that right, Leah?
Yeah, that's right. Because government just wants to minimise the movement around. So if we are minimising the movement, they still need the transactions. And we know that we're going to have far lower level of transactions. But I also I feel like there is momentum starting to build that there is going to be a lot more properties on the market in the coming months. So if you find something that you love, then make it subject to me inspecting it, pest and building, finance, whatever it is, because then you're the first one to negotiate.
Yeah, no, what I like about what you're saying, and I think it's reflective of the real estate industry as a whole, is they don't water finds its own level. So if the tide shifts, they just adjust and pivot. And like even what you just said before, I think is really out of the box thinking. But if you can do a Facebook Live whilst you're doing a final inspection, which gives you an opportunity to do a raw and ready video rather than some professional, because people don't trust, the buyers don't necessarily trust the glossy video. They like the raw organic one. So what I love is that the industry is looking for ways to make it happen, because I think one of the interesting things is it's not as if there's any lack of demand for property. It's not like the end of the world. I mean, you've got owner occupiers right now. I was talking to Ben before he hit record. Owner occupiers right now are frustrated as all buggery because they're ready to go. They want to buy, and if you're an investor, you go, well, okay, 6-week pause. That's not ideal, but I can do it. But if you're as a basic form of a basic need, which is shelter, and you can't do that for 6 weeks, you're frustrated. So the analogy we've used in the past is, when people can get back in the car, the car's fueled and the engine's tuned. And I was saying to Ben, this time at the end of stage 2, the car's fueled, the engine's fine-tuned, and someone's revving the motor. It's a red line.
In stage 4, that's right, Bryce. You're absolutely right. In stage 4, that's... And I think coming back to your point, Bryce, around investors potentially saying, sit on the fence, those good properties could be coming up. So it's, and as Leah rightly points out, if you can get a contract executed with plenty of clauses on there, that obviously that's the art of the negotiation, right? In terms of how much the vendor is going to accept, because it may not be a valid contract if the building and pest inspection comes in poorly, or there's some other issues that they have to get the deal over the line. But if you're a vendor and you're not getting any offers, but in some locations like city high-rise apartments and so forth, there's very sparse activity happening there. But if you're in a pocket of interest where there is that, the high revving owner-occupier, Bryce, those properties are under demand. And like Leah just mentioned, her two rental properties with 5 applications for each property. Can you give us an indication of the types of properties that they were, Leah?
Both were units. Off the top of my head, so we're in Melbourne. I'm pretty sure one was in Carrum Downs and one was in Cranbourne.
Okay.
But it was raw, and I think, like you guys have said, people want to see that rawness. People want to see, this is, let's look at the kitchen. Look at all the space. Look at, we can see it's a dishwasher, yes, but here is all this additional space. So if you've got kids, you could put blah, blah, blah in here. And it absolutely, it was really fascinating to watch the interaction as well.
Yeah, my point before, Ben, is that investors don't want to sit out, but they can stomach it a little bit more mentally than the owner-occupier, because clearly we've got investors who are keen to go. It's been a busy week. What do you anticipate sort of the next steps are for you, Leah? Clearly the last week would have been busy. I'm sure you would have had, members left, right and centre saying, help, can you give us clarity? What's going on? I mean, how do people within the real estate industry who listen to our podcast, how do they get their queries answered? And I guess what would be your message for real estate in general across the next sort of 5 weeks in Victoria?
Look, it's been really interesting because people are very nervous, and not nervous because of the lockdown. I think more nervous about the cost of the fines if they get it wrong. It's $20,000 for an individual and $100,000 for a business. So, we were even chatting last week, and some business owners said to me, oh, well, I'm going to issue a work permit for my team, but I'm only allowing them an hour here and an hour there. And I said to them, well, you've got to look at it from a practical point of view. You have to trust that they're going to do the right thing, and there has to be processes to say, okay, they can work between 9 and 5:30 on their work permit, but just make sure that you've got some processes in your office around where they're going, and they're going to be at that particular location for, X period of time. And again, around going to the office. Now, I've said to a lot of agents, when you're going to the office to collect keys or collect files for whatever the next appointment looks like, do as much in that office appointment as you possibly can. So if that means spending 10 more minutes opening a mail, if it means scanning invoices through so you can get those through to accounts, they're the sort of things that you guys need to think about, not just go, I'm just going into the office to pick up my keys.
Yeah, and make sure you have that COVID safe plan. That's obviously the other critical point in terms of how you're going to be looking after those people safely, because obviously that's the business risk there as well. So Leah, just my final one is around what's still on the agenda. What would you like clarity from the government on, or do you feel like that's it? This is how we're going to have to work, or is there anything else that you think you might get a win in regards to how we can conduct selling and buying of real estate, and obviously transitioning of tenants in properties?
Look, we know that professional photographers are definitely a no-no, and that's not going to change within the remainder of the lockdown period. I doubt very much that we will get the private one-on-ones in stage 4. I just can't see that happening. They've just been too strict with the movement aspect for real estate. There is still a lot of activity in regional Victoria that people need to realise. So in stage 3 regional, you can still do a private one-on-one, but you can't travel from stage 4 to stage 3 as prospective buyer, prospective tenant. But as an employee, you can go from stage 4 to stage 3. I think it's just also around that bit of clarity. I would love that agents were able to go to the property to be able to conduct that virtual open for inspection, particularly for those properties where they have been vacant prior to the lockdown, and maybe agents just didn't realise what they needed to quickly organise in those 48 hours that we had noticed before we're going to a shutdown. The other point, I think, just for agents that are listening, is remember that online auctions doesn't mean that you go to the office to conduct those online auctions. You have to do them from your home. So just making sure you can facilitate that.
Can I just get clarity on that? So a stage 4 employee can go to stage 3 to work?
Yes. Yeah. So an example in my office, we manage properties in Corio, Geelong as well.
Mm-hmm. Yep.
So we can go, and in fact, what we did on, I think it was Tuesday, I forget what day it is now. On Tuesday, it's staying home with the kids. I've lost my mind.
I hear you.
So on Tuesday, we did a virtual open in Corio for those that lived in stage 4 location, but we did private one-on-ones for those that lived in stage 3 location. So it is a bit complicated, and logistically, you've got to make sure you're right. But, I've said to a lot of agents, your processes just this week and probably next week are still going to be really clunky. It's because you're still finding your feet. And you know what? In 6 weeks, we're going to tip you all upside down, and we're going to have to do something different again.
Yeah. Well, I think we're finding ourselves in Victoria for the first time where you can get conditional contracts for purchase more than you ever have possibly been able to before, given we're such an auction-centric state. So I think the buyer might have a little 6-week bonanza. But hey, Leah, we appreciate your time. Is very much in demand. You've backed it up back to back with us on the last 2 episodes. We appreciate your insights. We know you're a busy professional, and thanks again for joining us on the Property Couch.
My pleasure.
So there you go, Ben. Very insightful. There's a few little extra tips there for buyers, for real estate agents, pretty much for anyone who's dealing with real estate in general in the current state of disaster, Ben, that is Victoria in stage 4 lockdown. So a very special thanks to Leah for making herself available again this week. We know she's her time is precious. She's in demand, and we appreciate that she's a good friend of the couch and continues to come and support us, Ben. So, mate, it's been a busy show.
Busy show. Yeah, and next week, the big 300s.
The big 300. We turned 300, Ben.
I know.
Who would have thought? So, no, we're excited about that. So we've got some good stuff
Donald
in
Bradman
line.
Territory.
Hey?
Donald Bradman territory.
Yeah. What are we going to get at 99 not out, are we?
No. He his high score was 333. So there's not too many people raising their bat at 300. Not out.
Just goes to show you don't follow cricket, Ben, because it was 334.
Oh, there you go.
Yeah. So there you go. But anyway, folks, until next week, Ben.
Knowledge is empowering, Bryce, but only if you act on it.
Well said. See you next week, folks.
Hey there folks, Bryce Holdaway here. Before you go, if you're new to our community and only listened to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarizes the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.